Hi, my name's Eric, and I'll be reading you selections from Barron's magazine with an issue date of October 27th of 2025. This reading is produced by the Audible Local Ledger, a reading service exclusively for people who are blind or print disabled. We'll start with Up and Down Wall Street. Is private asset star Blue Owl flying too close to the sun? This is by Andy Serwer. This past Tuesday, the upstart alternative investment firm with an aptitude for private credit announced a financing deal for Meta Platforms' $27 billion artificial intelligence data center in Louisiana. The week before, at the packed CAIS Alternative Assets Summit in Los Angeles, Blue Owl co-CEO Mark Lipschultz called J.P. Morgan Chase CEO Jamie Dimon's cockroach warning about risks in private credit, an odd kind of fear-mongering. And earlier this month, Blue Owl signaled that it was barreling into the $13 trillion retirement market. It's heady stuff for a firm that didn't even exist a decade ago. If the big alt firms, Carlyle Group, Blackstone, KKR, and even Apollo Global Management and Ares Management are now as familiar as J.P. Morgan, then where did this strangely named bird, Blue Owl, come from? As Paul Newman asked Robert Redford and Butch Cassidy in The Sundance Kid, who are those guys? It's extraordinary what they've done, says George Walker, CEO of the old line money management firm Neuberger Berman, and a cousin of the president's Bush, whose employees own a piece of Blue Owl via a trust. It was just a startup, and now their $26.6 billion market cap compares to a number of large, century-old financial institutions. Blue Owl's backstory entails some rich behind-the-scenes machinations, but more significantly, it reflects the stunning trajectory of private markets, which tripled to $26 trillion in assets over the past decade, according to a UMass study. The company is also central to what is au courant, the credit cycle and the AI boom, and as an investment opportunity itself, or not. Blue Owl is the pretty girl at the dance right now, says Wall Street trader David Williams. We're talking many billions in private credit. Ah, yes, private credit. Though Blue Owl has three lines of business, private credit, specifically direct lending in private equity deals, is the firm's calling card and growth engine, and the straw that's stirring Wall Street's punch bowl lately. Its core direct lending business, $145 billion in assets under management out of $284 billion total, was conceived in 2016 as Owl Rock at the Putnam Restaurant in Greenwich, Connecticut, comfort food at its best, by principals Doug Ostrover, formerly the O of GSO Capital Partners, now Blackstone Credit, Craig Packer, a former Goldman Sachs partner, and Lipschultz, a former KKR partner. The name came from the wisdom of an owl and stability of a rock, said Lipschultz, and the website was available. Instead of relying on the typical general limited partner private markets fund structure, Owl Rock used what are called business development companies, or BDCs, which issue stock and lend money to businesses, usually those with junk credit ratings. Other major alt firms have also turned to BDCs, which sport high yields. BDCs send some 90% of the interest collected on those loans to shareholders through dividends, similar to REITs, or real estate investment trusts. Two of Blue Owl's BDCs are publicly traded. Others are private. Blue Owl Capital Corp., which yields 11.4%, and Blue Owl Technology Finance at 9.9%, are both down about 14% this year, the former from January 1st and the latter from when it began trading on June 12th. Blue Owl stock at $16.68 has fallen 28% year-to-date, more than any of its alt firm peers, which signals either the risk of falling interest rates and weakening credit or a buying opportunity. Goldman Sachs recently called the fears overblown and cited Blue Owl as undervalued, noting that it has a stock price to fee-related earnings multiple, a common metric in that business, of 21.7, which is 5% below its two-year low. Blue Owl has generated a stable, highly predictable stream of earnings, said Ostrover, its other co-CEO. It makes no sense that we're down more than our peers. If anything, we should be down less. Wall Street may be particularly wary of direct lending, as shares of both Blue Owl and Ares, which specialize in that business, have fallen hard. It's also true that both stocks had previously outpaced their peers. The second leg of the Blue Owl stool was created years earlier, when a Lehman Brothers executive, Michael Reese, started a fund at Neuberger Berman, then owned by Lehman, that bought stakes in asset managers like D.E. Shaw. After Lehman collapsed in September of 2008 and Neuberger emerged from the ruins, Reese, with others, restarted the business. Reese's endeavor, named Dial after his children Dylan and Alexia, raised its own capital from Koch Industries, among others, and invested in the likes of Silver Lake and Vista Equity Partners. In 2020, Dial merged with Owl Rock through a special purpose acquisition company engineered by HPS Investment Partners, the private credit business that BlackRock recently bought, with a resulting company named Blue Owl. A bank working on the deal had called it Project Blue, so Blue was added and Rock was dropped. Neuberger employees retained a stake, which today amounts to some 25%. The hatching of Blue Owl was problematic to some companies in which Dial had invested, particularly Sixth Street Partners, formerly the private credit arm of TPG, and Golub Capital, both of which sued, claiming that the new company created a competitor with sensitive information about their operations. The defendant begged to differ and won in court. The direct lending and strategic capital businesses were once close in size, but soon the former outstripped the latter. Friction ensued between Reese and private credit honchos Ostrover and Lipschultz. Peace in the valley prevailed, though, and Reese remains co-president of the firm. Dial, renamed GP for General Partner Strategic Capital, today has assets under management of $67 billion, which, besides investments in asset managers, has stakes in National Basketball Association teams, including the Atlanta Hawks and the Sacramento Kings. In 2021, Blue Owl bought Oak Street Real Estate Capital, a Chicago-based firm specializing in sale-leasebacks and triple-net lease deals, as its third business. This wing of Blue Owl has AUM of $71 billion and is home to the Meta infrastructure deal and others, such as its Stargate data centers investment in Texas and New Mexico. Next, Blue Owl is working on deals with AI cloud company Nscale and investment firm Valor Equity to finance purchases from NVIDIA, for example, whose chips go for $30,000 and up, according to a person familiar with the matter. Blue Owl built its direct lending business by borrowing from the Silicon Valley playbook of scale first, monetize later, or by underpricing established private credit firms to gain deal flow and raising fees later. Most of the firm's direct lending business is done as part of private equity buyouts by PE firms like Thoma Bravo, Blackstone, and Warburg Pincus. These investments generally entail floating junk bonds, a business pioneered by Drexel Burnham in the 1980s. The private credit market grew from $2 trillion in 2020 to $3 trillion at the start of 2025, some of which came at the expense of big banks, which have been constrained by regulations promulgated in the wake of the 2008-2009 financial crisis. Was it sour grapes then when Jamie Dimon called out private credit firms over the recent spate of bankruptcies hitting banks? The money quote, "When you see one cockroach, there's probably more." Lipschultz fired right back at the CAIS conference. I guess Dimon is saying there might be a lot more cockroaches at JP Morgan. He played down the back and forth this past week, calling it colorful language that distracts from the core question, which is, are these isolated incidents somehow indicative of a broader issue in credit writ large? If they were, where would the problems live? I can tell you these isolated recent incidents bear no relation to private credit, and certainly no relation to Blue Owl. If he's right, Blue Owl could become the big bird of Wall Street, and if not, its wings will be clipped. Finding out what happened last week and what might happen this week in the review and preview section of Barron's. AI traders face off. Artificial intelligence chatbots have seemingly taken the world by storm. But can they trade like human pros? Not yet, judging by Alpha Arena, a new competition measuring the investing ability of 6 of the best-known large language models. NoFi One, an AI startup running the contest, gave each of the LLMs $10,000 each on October 17th and told them to invest in cryptocurrency futures. By this past Thursday, OpenAI's ChatGPT held a position worth just $2,752. That's a 72% drawdown in 6 days, and Google's Gemini tumbled 60%. Grok 4, run by Elon Musk's xAI, and Anthropic's Claude Sonnet also took losses. The only 2 LLMs in the green thus far are Alibaba's Qwen 3 Max and DeepSeek Chat, up 25% and 17% respectively. Of course, cryptos are volatile assets, but it shouldn't be a surprise that chatbots aren't yet good traders. They run on words, not numbers. Large language models are trained on historical data. They're backwards looking. And to win in markets, you have to be adaptive. NoFi CEO Jay Ajang tells Barron's, training LLMs to trade is a little like trying to get a goldfish to continue its train of thought. He hopes NoFi can solve the issue. NoFi is building a model trained on numbers, which it hopes will outperform the best investors. It set up Alpha Arena, which ends on November 3rd, to create a benchmark for how existing chatbots trade. The street's top traders look safe for now. Last week in the markets, Japan's parliament elected Sanae Takaichi as its first female prime minister, sending the Nikkei 225 to a high. The Argentine peso fell despite U.S. intervention, as Treasury's $20 billion rescue became embroiled in trade issues over soybeans and beef. The government shutdown dragged on. Gold tumbled 5.7% on Tuesday. That's the most since 2013. President Trump slapped sanctions on Russian oil and halted Canadian trade talks after an Ontario anti-tariff ad. Inflation edged up, but index records fell. On the week, the Dow Industrials rose 2.2%, the S&P 500 1.9%, and the Nasdaq Composite 2.3%. In companies, Amazon Web Services was hit by operational problems, disrupting apps and services globally. Zions Bancorp and Western Alliance Bancorp both reported higher earnings despite bad loan charges. The U.S. signed a deal for Australian rare earths. Netflix earnings disappointed after a dispute with Brazil tax authorities. Independent directors of Novo Nordisk stepped down after a conflict with its controlling foundation. Tesla profits fell 37% as Elon Musk urged approval of his trillion-dollar pay plan. Deals. Last week, Kering is selling its beauty unit to L'Oreal for $4.7 billion. The Wall Street Journal reported activist investor Starboard Value took a nearly 5% stake in Fluor. Blackstone and TPG agreed to take Hologic private for up to $18.3 billion. Institutional shareholder services and some large Core Scientific shareholders came out against its merger with CoreWeave. And this week, on October 28th, about 160 S&P companies report results, the busiest week on the third quarter earnings calendar, led by big tech. Booking Holdings, NextEra Energy, United Health Group, and Visa announce earnings on Tuesday, followed by Alphabet, Boeing, Caterpillar, Meta, Microsoft, Starbucks, and Verizon on Wednesday. On Thursday, Amazon.com, Apple, Bristol-Myers Squibb, Coinbase Global, Eli Lilly, Gilead Sciences, MasterCard, and Merck hold conference calls to discuss quarterly results. AbbVie, Chevron, and ExxonMobil close out the week reporting their earnings on Friday. On Wednesday, October 29th, the Federal Open Market Committee announces its monetary policy decision. A quarter percentage point rate cut is all but a done deal, bringing the federal funds rate to 3.75 to 4%. Wall Street's more interested in Fed Chair Jerome Powell's news conference and how many more interest rate cuts can be expected this year and in early 2026. Multiple Fed governors have emphasized the downside risk to the labor market in speeches since the mid-September FOMC meeting. Traders are pricing in a greater than 95% probability of a quarter-point rate cut at the December meeting as well, and a federal funds rate of 3 to 3.25% by June of next year, a full percentage point less than currently. By the numbers, $1.1 trillion, the record amount of U.S. margin debt in September, surging some $67 billion or 6.3% since August. 50%, that's the percentage of total spending by the top 10% of U.S. households, the highest since data was first collected in 1989. 100 plus, the number of ex-investment bankers helping OpenAI train its artificial intelligence to build financial models. And $7.7 trillion, the hit to the economy since 2000 from national and natural disasters, some 36% of GDP growth in that period. Our next article in this week's Barron's, Progressive got hit on earnings. Now it's on sale. Concerns about the insurer's growth have weighed on its shares, which are down 20% since peaking in April. They now look like a bargain, by Andrew Berry. Progressive is one of America's great financial companies, with a phenomenal record of growth in stock market performance since it went public in 1971. And now shares are on sale after falling over 20% from their April peak to about $219, including a 5% drop on recent news of a mild earnings disappointment in the September quarter. The stock flirted with a 52-week low on Friday, even as the S&P 500 index moved to a new high. Progressive, the number 2 U.S. auto insurer, is a financial growth stock, and unfortunately growth has been slowing in recent months. Though the company is still expanding rapidly, with automobile insurance policies in force up 15% year over year in September, that number's down from a 20% annual pace earlier this year. Pricing is coming under pressure too. Auto insurance prices rose by double digits in 2023 and 2024, but Friday's September Consumer Price Report showed a 0.3% monthly decline in premiums. At the same time, Progressive and its rivals are contending with continuing increases in car repair costs. Combined, those factors suggest that Progressive's growth could slow further. Its ample profit margins look set to decline in 2026, resulting in lower earnings relative to 2025. The stock reaction, however, appears to be another instance of the market putting short-term concerns before the long-term outlook. Progressive still possesses advantages in technology and data that make it the industry leader, while its long-term growth story remains intact. The stock also looks reasonably priced, at 12 times projected 2025 earnings of nearly $18 a share and 13 times estimated 2026 profits of $16.55 a share, especially for one that's been so solid for so long. Progressive's a wonderful company, says Greg Lowcroft, co-manager of the T. Rowe Price Financial Services Fund, who calls it the best-run auto and homeowners insurer. Long-term holders have nothing to complain about. The stock is up over 2,500-fold since Progressive's 1971 initial public offering at a split-adjusted price of about 8 cents. And it's outperformed both the S&P 500 and rival Berkshire Hathaway, which owns an auto insurer Geico, over the past 5, 10, and 20 years. Why has Progressive done so well? It was early in using telematics, or real-time driving information, and other analytics to price policies. While the company does use brokers, it has a larger presence in the faster-growing business of selling policies directly to consumers. It uses heavy advertising, including its pitchwoman Flo, to build brand awareness. And it empowers its managers in 50 states to price policies based on industry conditions and competitive dynamics. The proof is in the results. Progressive's revenue rose about 20% in both 2023 and 2024, and it's expected to rise 13% this year. Its auto underwriting profit margin of 12% last year was 7.5 points higher than the industry average, according to AM Best, and the gap could be similar this year. Based on its return on equity, Progressive is handily outperforming other top financial companies like JP Morgan Chase and Chubb as well. Progressive is a growth machine, says Adam Stiesel, Chief Investment Officer at Gravity Capital Management. It's a technology company that sells insurance. Progressive has room to expand in a fragmented auto insurance market. With a market share of just 17%, about 2 percentage points behind number one State Farm, it can take share from smaller insurers without its technology advantage. It may be only a matter of time before it surpasses State Farm, as it did Berkshire's Geico, to become the largest auto insurer in the U.S. Geico and Progressive used to grow at similar rates, but Progressive sped ahead in recent years. Progressive's auto policies in force are up 75% to 26.2 million since the end of 2019, while Geico's dropped about 10% to about 16 million. Barron's estimates as it moved to fix technology problems. Berkshire CEO Warren Buffett hailed Geico's spectacular improvement in his 2025 annual letter, but it's debatable whether it's anywhere close to Progressive in technology, though margins are now comparable. Progressive doesn't get the attention of other great financial companies, and that's partially by design. It doesn't meet with institutional investors, it avoids industry conferences, and it's based outside Cleveland. Still, the company is forthcoming about strategy on its quarterly earnings calls, and it's the only company in the S&P 500 that reports financial results monthly. Not everything's rosy. High auto insurance rates are becoming a potent political issue, and now prices are flat or falling in states like Florida. Progressive was so profitable in that state following legal reforms in 2023 that it will rebate some $950 million to Florida policyholders starting in 2026, based on outsized earnings from 2023 to 25 that exceeded statutory limits. The insurance industry is contending with the high cost of repairing cars, while the rise of self-driving over the next decade could cause accidents to drop, neutralizing some of Progressive's underwriting advantages. The company, however, is expected to exceed its minimum underwriting profit margin target of 4% and to continue taking market share. Progressive also has an innovative capital return program. Like another industry leader, Costco Wholesale, it supplements a tiny regular dividend, now 40 cents annually, with periodic special dividends when it builds up excess capital. Progressive declared a $4.50 special dividend at the end of 2024, and T. Rowe Lowcraft expects a similar declaration at the end of 2025 and possibly another in 2026. Progressive stock also commands an undemanding valuation. At 12 times 2025 earnings, its price-to-earnings ratio is well below its 10-year average of 16 and the S&P 500's current 22. Raymond James analyst Greg Peters recently reiterated what he called an out-of-consensus, outperform rating on the stock, citing his expectation that Progressive will continue to generate above-target profitability. While he cut his price target to $265 from $305 a share, that still suggests more than 20% upside. When great companies go on sale, it's usually a good time to buy, and Progressive is a great company. America's largest natural gas producer can help meet AI energy demand. Expand Energy has an advantageous geographic footprint and multiple synergies flowing to its bottom line, by Teresa Rivas. Pull up your favorite AI chatbot and ask it about the weather for this weekend, how to score the best holiday deals, or to tell you the meaning of life. You've just helped the bull case for Expand Energy. The company, created by the 2024 merger of Chesapeake Energy and Southwestern Energy, is now the nation's largest natural gas producer. With an advantageous geographic footprint, ongoing synergies flowing to the bottom line, and growing energy demand, it also looks like one of the best buys in the industry. The outlook for natural gas demand is pretty strong, says Ben Cook, portfolio manager of the Hennessy Midstream Fund. There's an increasing need for it as a fuel source for the power generation facilities that deliver electricity to data centers, and you can't flip the switch on alternatives like nuclear energy overnight. Geographically, Expand Energy has an advantage as most of its assets are in northwest Louisiana and the Haynesville Shale, giving its proximity to most of the liquefied natural gas, or LNG, export capacity that's being built out, Cook says. That will be increasingly valuable as the amount of natural gas produced goes up. Projecting from current projects, LNG export capacity could double by 2029, the U.S. Energy Information Administration notes, as sustained prices incentivize higher production. Expand Energy, which is using its robust cash position to do more drilling, is at the forefront of that push. Expand Energy offers attractive free cash flow growth from rising prices and volumes in 2025 and 26 as deferred wells are brought online and synergies are realized, writes Morgan Stanley analyst Devin McDermott, whose price target on the stock is $135, up from a recent $103.77. While the company originally projected some $400 million in annual synergies after its merger, the figure has come in ahead of targets. McDermott pegs it at roughly $600 million a year by the end of 2026 and estimates that its free cash flow yield will climb from 9% in 2025 to 16% next year. That'll also help fund its base and variable dividend yield, which was 3.1% over the past year, as well as ongoing stock buybacks under its late 2024 $1 billion repurchase authorization. Benchmark analyst Subhash Chandra made a similar point in reiterating a buy rating in early October. The company can grow margins from gas marketing, as the country's largest gas producer can add meaningfully to free cash flow, he wrote. We expect the strategy will be fleshed out in ensuing quarters through strategic acquisitions of assets and personnel. Transformation is less the goal than incremental and sustainable growth in free cash flow. Likewise, consensus estimates call for Expand Energy's earnings to jump by more than two-thirds, from $5.69 in 2025 to $9.63 in 2026. Analysts are by and large an optimistic bunch, but it's worth noting that nearly 90% of the 33 tracked by FactSet rate Expand Energy at buy or the equivalent. There are no bearish calls on the street, and the average analyst price target of $131 implies more than 25% upside from current levels. Investors might be concerned with Expand Energy's volatility, given the stock dropped some 22% from its peak in June through the middle of September. Yet those declines were largely a function of a decline in natural gas prices, driven in no small part by unfavorable weather trends. That should reverse with a more normal winter, says Cook, and of course artificial intelligence demand isn't weather dependent. Global data center electricity demand is expected to more than double between 2024 and 2030, with much of that coming from AI. Electricity demand from AI-optimized data centers is projected to more than quadruple by 2030. The U.S. is the single largest market for data center growth. In fact, the stock has begun to rebound from its summer lows, but Expand Energy still changes hands for a modest 11 times 2026 earnings despite strong expected growth. UBS analyst Josh Silverstein raised his estimates ahead of Expand Energy's earnings results. due on October 28th, noting that another catalyst could be an update in the search for a new chief financial officer after the departure of the previous CFO in August. Despite the volatility, he says Expand Energy is still, quote, best positioned for rising natural gas prices next year, with the ability to increase volumes and shareholder returns while also reducing debt. In short, winter is coming. But instead of being a warning, it's welcome news for Expand Energy. Its shareholders may not be able to keep their heating bill from skyrocketing, but they can still profit from it. On to the cover story. Uncle Sam's new activism is here to stay. The U.S. is aggressively buying stakes in publicly traded companies. The strategy's winning broad support, and the stocks are flying. By Joe Light. Uncle Sam is becoming America's most powerful investor, taking big stakes in companies to bolster supply chains and make money for taxpayers. Both goals have bipartisan support, which suggests this new shareholder activism will far outlast President Donald Trump's administration. Under this unfolding form of American state capitalism, the U.S. is pushing the boundaries of its legal authority to invest billions of dollars in a growing number of companies in return for stock. A third driving force is to beat China, whose control over some materials and manufacturing processes has exposed critical national security weaknesses for the U.S. amid trade tensions. Under Trump, the government has taken stakes in chip maker Intel and critical minerals firms such as MP Materials and Lithium Americas. Lawyers say some company boards are clamoring to take on the government as a shareholder, while others are wary that they may be forced to give up equity or some sort of control in exchange for permits or other approvals. Some managers believe U.S. investment has given their firms a leg up, although free market advocates warn there's a litany of examples where government heavy-handedness has had poor consequences for the economy. While some Democrats criticize the moves as lacking strategy, the taking of equity stakes in some cases has bipartisan support. Trump officials say they're just getting started. Treasury Secretary Scott Bessent has said the White House is homing in on industries critical to U.S. national, which government officials say has manipulated prices, meaning China, to undercut U.S. industries and give itself a strategic advantage. I wouldn't be surprised if the U.S. took more stakes in private companies, Bessent said at a CNBC event October 15th. When you're facing a non-market economy like China, then you have to exercise industrial policy. Just as often, the White House targets seem to be ones of opportunity. The U.S. took its stake in Intel days after Trump called for the ouster of its CEO, with Trump arguing that he was rectifying an unfair deal for taxpayers made by President Joe Biden's administration. In November of 2024, the Biden administration announced that Intel would receive nearly $8 billion in grants to support the company's $100 billion investment in building semiconductor projects in the U.S. But the U.S. didn't receive any equity as part of the deal. In addition to its national security goals, White House and cabinet officials say they want to make money for taxpayers. Why are we giving a company worth $100 billion this kind of money? What's in it for the American taxpayer? And the answer Donald Trump has is we should get an equity stake for our money, U.S. Commerce Secretary Howard Lutnick told CNBC as the Intel stake was completed. The Defense Department invested $400 million in July in MP Materials, which operates a rare earth mine in California. The preferred stock and warrant for common stock give the government a 15% stake in the company, making the U.S. its largest shareholder. As part of the deal, the government also guaranteed a minimum price for some of its rare earth products and said the Pentagon would find customers for 100% of the magnets produced at a new facility for a decade after its completion. This month, the government struck 2 more critical minerals deals, taking 5% stakes in Vancouver-based Lithium Americas and in one of its joint ventures, and a 10% stake in Vancouver-based Trilogy Metals, with warrants to acquire another 7.5% of the company. In addition to the money, the U.S. approved a 211-mile road for a mineral project in Alaska, reversing a decision made by Biden. A U.S. investment is enormously accelerating and transformational and valuable, says Brian Minnell, CEO of TechMet, a mining and mineral investments company. The first Trump administration invested $25 million in TechMet in 2020 through the U.S. International Development Finance Corp., which Congress originally created in 2018 to support development projects in low-income countries. The DFC during the Biden administration invested another $80 million. A U.S. equity investment de-risks projects in the eyes of other investors and foreign governments. Minnell says the U.S. involvement was a major selling point when TechMet raised $180 million from the Qatar Investment Authority. And governments around the world are very respectful of U.S. interests unless they're completely stupid, Minnell says. It's been positive for us everywhere. Despite talk early in the administration of creating a sovereign wealth fund, the White House says it isn't seeking to build a large portfolio of U.S. companies. It sees equity stakes as just part of its toolkit to firm up the U.S. supply chain. The point with equity stakes is that the president's making sure the taxpayer isn't needlessly giving out money with no strings attached, said a White House official who called any financial returns to taxpayers an ancillary benefit to national security interests. There is no one person at the White House tasked with overseeing a portfolio of investments, the official said. Critics note that taking stock in a company doesn't necessarily do much to firm up supply chains. The U.S.'s original deal with Intel provided the company with grants, loans, and tax incentives in exchange for the company meeting certain milestones to build semiconductor projects in the U.S., an endeavor that Intel and other chip makers said wasn't otherwise economically viable. As part of the deal to convert the grants and loans into equity, the Trump White House removed the milestones. Some deals have given the U.S. influence over corporate actions, but without any stock. In August, NVIDIA and Advanced Micro Devices agreed to give the U.S. 15% of their revenue from artificial intelligence chip sales to China in exchange for export licenses. Later in the month, the White House said the deal hadn't been finalized, and China banned the chip sales in any case. An NVIDIA spokesman declined to comment. AMD also didn't respond to a request for comment. As a condition for approving the sale of U.S. steel to Japan's Nippon Steel, the government received a so-called golden share, giving it veto power over some corporate actions. These demands to take a percentage of profits or actual equity ownership to operate in different markets are nothing more than extortion schemes, says Jeffrey Sonnenfeld, president of the Yale Chief Executive Leadership Institute. The rare earth deals have kicked off a gold rush among companies looking to see if they can get Uncle Sam as an investor as well. Just this past week, the Wall Street Journal reported that some quantum computing companies are in discussions to give the Commerce Department equity stakes in exchange for funding. Why David Scharf, one of Trump's former attorneys, says 20 to 30 companies in industries ranging from critical minerals to manufacturing and robotics have reached out to him to see if he could help line up a U.S. investment, which he has whittled down to a handful for pitches to government agencies. Although the investment discussions are often to further national security interests, he says government officials are also looking for a positive investment return. Everyone is working across the table from each other to make money, says Scharf. The government hasn't released a comprehensive accounting of what it's made from its investments, but anecdotally, the returns so far are robust. TechMet's Minnell says the government has made 30% annually on its investment in the private company. MP Materials recently traded at about $83, more than double the conversion and exercise price that the company gave the government in its funding deal. In exchange for deferring $184 million in debt payments, the government received 5% of Lithium Americas, a stake worth $93 million. And in perhaps its most lucrative investment, the government in August agreed to buy 9.9% of Intel at $20.47 per share, a discount to the market price. The stock recently traded at around $38. On its face, the government's terms have often looked dilutive to private shareholders, but in the early days, a U.S. investment has almost always been accompanied by a surge in the target's share price. Shareholders have enjoyed gains alongside the government. Trump officials have pointed to several industries they view as critical to national security interests that could end up getting U.S. investments. Lutnick and Trump in interviews have suggested that defense contractors, who often have the U.S. as their biggest or only customer, could be targets. At the CNBC event on October 15th, Besant said that the U.S. has identified 7 critical industries where equity stakes might be on the table, but didn't name them. We're not going to come in and take stakes in non-strategic industries, he said. We do have to be very careful not to overreach. The Treasury Department didn't respond to requests for comment on what the 7 industries are. In many cases, the government is giving support to industries that traditionally have found it too risky or expensive to operate in the U.S. Setting up a rare earths mine is risky, even before taking into account the mineral's highly volatile prices. Steel companies for years have said they can't compete with China's state-sponsored companies, which sell some forms of steel at prices that would cause the U.S. firms to lose money. Congress passed the CHIPS and Science Act in 2022 in part because nearly all advanced chip making happens in Taiwan. There's a shared bipartisan sense that these are sectors and industries that we want to make sure we have good domestic production and stockpiles of, says Beacon Policy Advisors analyst Owen Tedford. There's some degree of shared bipartisan belief that even if the method isn't the best, the outcome will be worthwhile in the long term. The government's track record in taking equity stakes is mixed. To help stabilize the financial system, the U.S. in 2008, under the Troubled Asset Relief Program, took equity stakes in major banks, insurer American International Group, AIG, and auto companies. Government officials in 2014 said they had recovered $441.7 billion from those investments, compared with $426.4 billion dispersed. A positive return, but one that critics say wasn't commensurate with the risk. Although taking equity stakes outside of crises is unusual, legal experts say there's nothing inherently illegal about it. Congress authorized the government to take stock in companies through the International Development Finance Corp, which has made some rare earth deals. The act that enabled the funding for the Intel deal didn't explicitly talk about the U.S. taking shares, but it didn't prohibit it either. And since Intel voluntarily entered the agreement, it isn't clear who would sue. So long as the companies formally consent to the government shares, the government is unlikely to face lawsuits in court, wrote former Biden White House official Peter Harrell on the Lawfare website. The push for government equity stakes may even continue if a Democrat wins the White House. Senator Bernie Sanders praised the Intel deal in a statement, saying that the taxpayers of America have a right to a reasonable return in exchange for grants to chip makers. Some officials from the Biden White House say there's nothing inherently wrong with the tactic of taking equity in exchange for government help. An equity stake is an industrial policy tool, just like a grant, a tax credit, a loan, or a tariff. They can be used in smart and strategic ways, but they can also be used in clumsy and misapplied ways, says Alex Jaquez, Chief of Policy and Advocacy at Groundwork Collaborative and a former White House official in Biden's National Economic Council. Jaquez says Trump seemed to be treating the equity investments as a vanity play and personal portfolio. The chief executives of some of America's top corporations sounded alarm bells at a gathering last month in Washington. They expressed acute anxiety that Trump is asserting unprecedented control over company governance. They view this as a huge mistake, says Sonnenfeld, who organized the meeting. Many leaders of large companies blanch at the government taking equity but won't speak out in public for fear of becoming a Trump target, says Sonnenfeld. What's more, some of them see winning U.S. government support as a way to undercut rivals and get a short-term opportunity to get a brief stock pop, he says. In the longer term, there's a risk of government heavy-handedness, undermining the conditions that have made the U.S. economy successful relative to its peers, says Norbert Michel, a vice president at the Cato Institute, a libertarian think tank. You don't have to go too far to get to a completely different economic system, Michel says. There's no clearly defined line that says, well, if you only have the government taking a 5% stake in 5 companies, then it's not fascism or not socialism. We shouldn't be doing this because that's where this leads. What comes after the U.S. builds its portfolio is mostly unknown. With Intel, the White House agreed not to take governance rights, but it's already put its thumb on the scale in other arrangements. Trump exercised his U.S. Steel veto power for the first time last month, blocking a decision to stop processing raw steel at a plant in Illinois. A White House official in September told Barron's that stopping processing was perhaps a sensible business decision, but against U.S. interests. A U.S. Steel spokeswoman says there would have been no layoffs in any case and called the Trump administration a great friend to the American steel industry. Moving on in the Barron's of October 27th, 24-hour trading is coming. Wall Street isn't ready. Extended trading could change everything from staffing models to market volatility. What happens when a bank collapses at 1 a.m.? By David Wignall. Wall Street employees agree that 24-hour trading is inevitable. It doesn't mean they're happy about it. For years, investors hoping to trade U.S. equities on major exchanges were confined to the traditional hours of 9:30 a.m. to 4 p.m. Eastern Time 5 days a week. Some exchanges also offered extended hours, starting at 4 a.m. and ending at 8 p.m. But soon, round-the-clock equity trading will be the new normal. The New York Stock Exchange, NASDAQ, and the London Stock Exchange are all weighing plans to extend weekday trading deep into the night. Robinhood Markets, Interactive Brokers, First Trade, and Charles Schwab all already offer 24-hour trading 5 days a week for many stocks. And a key market infrastructure provider, the Depository Trust and Clearing Corp., says it's preparing to accommodate round-the-clock trading as soon as the second quarter of 2026. For now, the weekend is still off limits, but finance professionals across Wall Street are watching the advances of 24-hour trading with trepidation. They wonder, will asset managers need to staff their offices at midnight? Will nighttime liquidity harm retail investors? What happens if a bank collapses at 1 a.m.? Jenny Hadiaris, head of North America Electronic Execution at Citigroup, says that while retail clients are excited about round-the-clock trading, institutional investors have been a lot more tepid on this. And she adds, it's a huge lift. It's a massive lift for the street. Financial advisors also see potential trouble ahead. Imagine going through COVID-19, the fastest drop in history, with a market that never closes, says Peter Maluk, president of Creative Planning, a large wealth manager. We're not staffed for round-the-clock client assistance. The push for round-the-clock exchanges are moving to round-the-clock trading for many reasons. They want to cater to Asian retail investors who are increasingly interested in big-name U.S. stocks like Nvidia and Microsoft. They're following the lead of cryptocurrency and commodities markets, which already trade continuously. And they want to encourage more foreign companies to list their stocks in the U.S. Some wonder whether the appetite is even there. Just 11% of overall trading volume in 2025 took place outside the traditional 9:30 a.m. to 4 p.m., according to NASDAQ. Trading from 8 p.m. to 4 a.m. is even thinner, accounting for only 0.2% of total volume. There's pros, there's cons. It doesn't matter. It's coming. In conversations with Barron's, more than a dozen financial professionals voiced a variety of concerns regarding the impact of 24-hour trading, though they also stressed that the change is inevitable. Many worry about liquidity and execution. When few participants are trading, market makers must hold on to shares for longer. To To compensate for the increased risk, they widened their bid and ask spreads, the gap between the cost of buying and selling shares. At night, when almost no one's trading and not all market makers are offering their services, spreads can be unusually wide. If unsuspecting investors place orders at night when spreads are broad, they will effectively receive worse prices than if they wait for daylight. A lot of people don't realize that they're likely to do far worse in terms of price if they're going to trade overnight, says Benjamin Schifrin, Director of Securities Policy at Better Markets, an advocacy group. Schifrin believes that if overnight trading is conducted on exchanges, spreads could narrow somewhat, but far more retail investors would be exposed to the risks. Low liquidity wouldn't just harm individual investors. If an investor places a large sell order and there are few buyers available, prices could fall, potentially triggering additional automated selling. There could be many flash crashes, says Lynn Challenger, Global Head of Trading at UBS Asset Management. When the market is thin, anybody buying or selling at the wrong moment could lose their shirt. In the short term, many trading experts expect liquidity to be extremely thin between 8 p.m. and 4, but some traders and exchanges are hoping that NYSE and NASDAQ's moves will induce additional activity. Us coming into the market will likely unlock additional demand, says Chuck Mack, Senior Vice President for North American Markets at NASDAQ. If that demand materializes, it could be a tremendous boon for traders and exchanges, since both typically profit when more people are buying and selling stocks. But when there's no closing bell, it can also disrupt life on Wall Street. Doesn't matter what your view is, says Hidearis, but volumes could pick up when big events occur, like a presidential election or geopolitical crisis. Many traders and investors have come to appreciate the closing bell. After 4 p.m., they have ample time to clean up their books, meet with coworkers, schmooze with clients, and grab some sleep. While asset prices technically move overnight, the tape is out of sight and the volume is thin. In a continuously trading world, stock price movements would always be in view. I think for the equities traders, it'll be a new level of stress and anxiety because they'll never get a break, says John Shamus, Chief Growth Officer at Drive Wealth, a financial technology company that helps investors operate overnight. For the futures and options traders, they're used to this because those assets already trade at nearly all hours. Investors who enjoy an evening cocktail aren't the only ones who rely on the closing bell. Currently, exchanges and brokers use the dead of night to handle a host of rarely thought of functions. Trades must be settled, closing prices recorded, stocks split, mistakes reversed, and dividends paid. In a round-the-clock world, it's still unclear how the market plumbing will operate. Most broker-dealers are used to having a 6+ hour period when they can do all their corporate action processing, says Shamus. Staffing's an obvious issue. If the market's going to be open, regardless of whether there's a lot of liquidity or not, it could create price risk for investors, says Michael Cyprus, an equity analyst at Morgan Stanley. Someone will need to be awake to manage that risk, at least at firms with demanding clients. The Securities Industry and Financial Markets Association, a trade group, noted in a Securities and Exchange Commission filing that overnight on-exchange trading will require additional staffing at regulators, firms, and third-party service providers to monitor systems and respond to clients. The trade group asked, who pays for these increased costs? Those costs could fuel further consolidation. Many large traders and asset managers already have staff awake at all hours. If a price moves while New York is asleep, employees in Singapore are able to respond. But smaller firms without global presences will be out of luck. So who will benefit? Many finance professionals are also wondering what might happen when market-shifting news happens during the wee hours. On the one hand, overnight exchange trading will allow more asset managers to respond to events in real time, so their portfolios will always reflect their views on current information. On the other, Overnight trading, especially when more retail investors get involved, could cause investors to respond impulsively. Rather than waiting until morning when cooler heads may prevail, investors could jump into the fray right away. It heightens the probability that you get an emotional response to market events, says Christy Mitchum, a founder of Wealth Manager and Partners who was previously CEO of Wells Fargo Asset Management. If investors react impulsively, the people who benefit will be the professionals, the hedge funds, proprietary traders, and algorithmic funds who already dominate pre- and post-market trading and can take advantage of irrationally priced assets. My view of 24-hour trading is it has little benefit, says Victor Hagani, a wealth manager who co-founded Long-Term Capital Management. It's just going to facilitate a greater redistribution of wealth from retail speculators to proprietary traders. The rise of 24-hour trading could also privilege high-speed computerized operations. Under the current system, there's little benefit to reading a news release at 8 p.m. as opposed to 8:05 p.m. All investors have to wait until the morning to place their trades, giving everyone ample time to receive and digest information. But if the exchanges are open when news arrives, reaction times might become more important. Using machine learning and web-scraping tools to consume information, already par for the course for some funds operating in the daytime, could become even more important. A senior trading executive at a large U.S. bank noted that overnight trading could exacerbate market contagion. The executive observed that during the collapse of Bear Stearns in March of 2008, regulators and executives had several nights and a weekend to organize a bailout and sale of the beleaguered bank. That breathing room may soon be in short supply. Imagine if when GameStop was happening, the markets were open 24/7, says Better Markets Schifrin. I think it was hard enough for the SEC and others to understand what was transpiring in the market then. Skeptical of the benefits and wary of thin liquidity, many investors say they're planning to stay away from overnight trading and expect others to do the same. Buy and hold, and institutional investors would probably sit on the sidelines, says Michael Arone, chief investment strategist at State Street. That could create a chicken and egg scenario. If institutional investors don't provide overnight liquidity, then trading volumes will remain low, making nighttime trading less appealing to institutional investors. The graveyard shift will become the domain of retail investors and specialized firms. But competitive pressure may compel asset managers and traders to build overnight capabilities anyway. If I don't get that type of service from one counterpart, I'll go to the next one who provides it, said Veneer Bansali, founder and chief investment officer of Longtail Alpha, a hedge fund. We're talking about millions of dollars of opportunity lost. Overnight trading will catch on, Shamus predicts. This is going to be a feature like fractional shares, where it's going to be something that everyone has over the next 5 years. Some brokers may never be able to support 24-hour monitoring due to technical inefficiency, he says, but customers will demand and expect it. And with that, we've come to the end of our reading of Barron's magazine with an issue date of October 27th of 2025. This is your reader, Eric, saying be well, be safe, look after each other, and remember our veterans, especially those we've lost recently. Bye for now.